Welcome to this explainer. Today, we're going to completely deconstruct Aswath Damodaran's master framework for valuing a business. And we aren't just talking about a piece of it. We're talking about the entire firm, the whole pie, including both the debt and the equity. If you really want to know what a company is fundamentally worth, well beyond the daily noise of the stock ticker, you are in the absolute right place. To set our philosophical foundation right out of the gate, let's think about this brilliant quote from Oscar Wilde. A cynic is a man who knows the price of everything and the value of nothing. In the world of finance, this perfectly captures the difference between market price and intrinsic value. Sound investing requires the absolute understanding that a shifting market price doesn't always equal the true underlying worth of a business.
So here's our roadmap for discovering a firm's true fundamental worth. 1. Price versus intrinsic value. 2. Valuing the entire firm. 3. Cash flows and capital costs. 4. Valuing the firm in pieces. 5. Estimating terminal value. And finally, 6. The final valuation verdict.
Section 1. Price versus intrinsic value, the philosophical basis of investing. Intrinsic value is essentially the true, fundamental, mathematically backed value of an asset. Imagine an all-knowing analyst who has absolute precision regarding a company's expected cash flows and the exact right discount rate. That perfect number they arrive at, that's the intrinsic value. We've got to avoid what Damodaran calls the dangerous bigger fool theory. Buying an overpriced asset just hoping a bigger fool is going to pay even more for it later. By pursuing intrinsic value, we make sure we never pay more for an asset than its cash flows prove it's actually worth.
Moving right along to Section 2. Valuing the entire firm, the whole pie versus one slice. Here is the absolute core distinction. You can value just the equity slice by looking at cash flows left over after debt payments, discounted at the cost of equity. But the other approach, which is our primary focus today, is firm valuation. Here we're valuing the entire pre-debt pie. We use the free cash flow to the firm and discount it using the weighted average cost of capital. Valuing the whole firm is just a much cleaner, more reliable approach, especially when a company's debt ratio is bouncing all over the place. It totally saves you from the messy accounting of trying to project specific debt repayments years into the future. Section 3. Cash flows and capital costs, the engine of valuation. So what's the underlying mathematical engine driving this firm-level valuation? First up, the numerator, free cash flow to the firm, or FCFF. These are the residual cash flows after a company has paid its operating expenses, reinvested back into the business, and paid its taxes. But crucially, this is prior to any debt or equity payments. It is a strictly pre-debt cash flow. Think of FCFF as the total unencumbered pool of money generated by the business that belongs to everyone, the bondholders and the stockholders alike.
Next, our denominator, the discount rate. This is the weighted average cost of capital, commonly known as WACC. Every firm finances its operations through a mix of equity and debt. The WACC simply measures the cost of those different components, weighted by their market value proportions. What makes WACC so incredibly vital when valuing the whole firm is how beautifully it balances leverage. Embedded right there in the WACC are the tax benefits of debt, perfectly weighed against the higher expected risks of carrying all that borrowing.
It's really fascinating to see the exact divergence between equity cash flows and the much larger firm cash flows over time. Take the first year, for example. The cash flow to equity is $50, but the cash flow to the firm is $90. Why? Well, because the firm cash flow includes that $40 of long-term interest before it even gets paid out. If you track this across 5 years, you clearly see how much larger the total firm pie is compared to just the equity slice. Let's see how this actually builds. If we take those exact firm cash flows and discount them at the WACC, which in this specific scenario is 9.94%, we arrive at the total present value of the firm, $1,873. But as an investor, you ultimately want to know the value of your equity, right? So how do we extract the equity slice from the whole pie? It is remarkably simple. You take that total present value of the firm, and you just subtract the market value of the outstanding debt. In this case, subtracting the $800 in debt leaves a pure equity value of $1,073.
Section 4. Valuing the firm in pieces, the APV approach. Now, you might be wondering, is there another way to value the firm's operations and debt separately? Yes, there absolutely is. It's called the adjusted present value, or APV approach, and it follows a highly logical sequence.
Step 1. You pretend the firm has zero debt and value its core operations purely as an all-equity financed business. Step 2. You recognize that debt does actually exist and add the present value of the tax benefits flowing from that debt. Step 3. You subtract the expected bankruptcy costs, because, obviously, as debt rises, so does the risk of failure. It's a great way to systematically adjust the unlevered value for the actual financial realities of carrying debt. This data from Disney perfectly demonstrates APV in reality, and it's quite surprising. As Disney's debt ratio increases from 0 to 10 and then to 20%, the total value of the firm actually goes up. The tax benefits of debt are adding massive value. However, if you keep following it right around a 50% debt ratio, the firm value peaks at nearly $67 billion. After that, the expected bankruptcy costs just explode, dragging the total value of the levered firm right back down. It's an absolutely fantastic visual representation of the double-edged sword of leverage. Section 5. Estimating the terminal value, tackling the infinite future. This brings us to a really fascinating question. How exactly do you value a firm that lives forever? Unlike a bond that matures on a specific date, a corporation has an indefinite lifespan. But because we can't project individual cash flows into infinity, our spreadsheets would literally break, we have to impose what Damodaran calls closure on our model. We do this by stopping our year-by-year estimation at a specific point and computing what's known as a terminal value. There are basically three main methods to calculate this terminal value. Number 1 is liquidation value, just assuming you sell off all the assets at the end of the period. Number 2 is the multiple approach, applying an industry multiple, like a price-to-earnings ratio, to the final year's revenues. But a quick warning here. Using multiples inside a discounted cash flow model creates a dangerous, polluted mix of relative and intrinsic valuation. If you want a true intrinsic valuation, method number 3, the stable growth model, is the most philosophically consistent choice. It simply assumes that beyond the terminal year, the firm's cash flows will grow at a constant, perpetual rate forever.
Section 6. The final valuation verdict. Putting it all together. Okay, here is your master formula for moving from a comprehensive firm valuation to a final actionable equity value. Step 1. Value the operating assets. You do this by taking the present value of your explicit free cash flows to the firm and adding the present value of your terminal value. Step 2. Add any cash and marketable securities. Those are assets that belong to the claim holders, but they aren't generating operating cash flow. This gives you the total firm value. Finally, step 3, subtract all non-equity claims, which primarily means the market value of the outstanding debt. What you are left with is the pure intrinsic value of the equity. Divide that by your share count and boom, you have your intrinsic value per share.
We're going to leave you today with a bit of a provocative question. If market prices are driven by the bigger fool theory, do you actually know the true intrinsic value of what you own? We've seen today that by valuing the whole pie using free cash flow to the firm and the cost of capital, we can completely strip away the noise of shifting market perceptions and volatile leverage. It challenges us to stop relying on what someone else might pay tomorrow and start doing the really rigorous work of analyzing the underlying cash flow engine today. Keep this framework in mind the next time you look at a stock ticker. Thank you so much for joining this explainer, and keep learning.